Barclays is happy with Lehman, maybe signs of a new housing bubble, and Bank of America is nice and boring. You're in the right place, folks, because this is where the money is. Welcome to the show. I am Matt Copenheffer, and right next to me here is David Hansen. David, AMC is reportedly doing a spin-off to Breaking Bad called Better Call Saul. Who would your first call be if you were caught dealing meth?
It's got to be my brother down in Charlotte. He's a lawyer. Might have to drive up here to DC, but I think he could take care of it. How about you?
Saul Goodman and your family?
You calling your wife?
Not calling my wife. Starting off as we always do with the headlines, we've got a good one here, or a good one for us, not so good for the insurance companies. Over at DealBook, they said New York regulator sees abuse increasing under new insurance rules. This is Benjamin Losky, the insurance regulator in New York. The article says several big life insurers are going to have to set aside a total of at least $4 billion because New York regulators believe they have been manipulating new rules meant to make sure they have adequate reserves to pay out claims. Concern for investors?
A little bit. I mean, anytime you're talking about accounting and the balance sheet not looking like it should according to regulators, and the companies they mentioned here that sell this product that was under scrutiny, it was known as Universal Life, Lincoln National, Genworth, Principal. So these are some big players there. I think it should be at least somewhat of a concern for investors. What do you think?
Well, life insurance, I get life insurance. I get the life insurance product. If I go out and I get hit by a bus tomorrow, somebody gets money.
I do.
But yeah, exactly. You're going to be my beneficiary. You're the first person that I'm not calling my wife when I get caught dealing meth, but I'm going to give you all of my money from my life insurance policy. But so many life insurance policies now have these all different benefits and cash values, and they've become investment products. And in a lot of cases, they're just not very good investment products. I guess that's kind of separate from the discussion. But from an investment perspective, I have trouble getting too excited about companies that are focusing on life insurance products that have those kind of products. And I think you were about to mention this, but the main companies that the article mentioned, Lincoln National, Genworth, Principal, John Hancock, U.S. Life, and Sun Life, are the ones that they're talking about having to set aside another $4 billion. And the product in question is Universal Life with secondary guarantees. They said it's insurance that offers both death benefits and a cash value to policyholders. So it's that kind of contingent thing that I was talking about. And this makes it a little bit confusing for the accounting and what needs to be reserved. And this is the problem that Losky is having with these companies and saying that they're trying to game the system in terms of how much they're reserving. So $4 billion, first of all, a lot of money, and the potential that these companies are under-reserved, that's a concern as well. So I think that this is something that investors should be watching closely.
Right. All right, next one, we're going over to the FT. The headline is Barclays Lehman, many happy returns. So 5 years later, after the Lehman bankruptcy, Barclays did scoop up some of the operations that Lehman had, and it's turned out to be a pretty fruitful investment for them compared to what Bank of America paid for Merrill Lynch there. Obviously a big difference in price. Barclays basically got Lehman for pennies there, and they're pretty happy today.
Barclays, if you've been watching over the past couple of years, you might think of Barclays as the bad news bears. I mean, it's been one thing after another. The changeover at the CEO position, the LIBOR scandal, it's been awful at Barclays. But when you look back at this deal, this was great. This is where is it from the article here? Barclays spent just $250 million for the Lehman investment banking and capital markets business. Then they say it spent another $1.5 billion for the corporate headquarters and 2 data centers. They said all of which have surely appreciated as well. $250 million for the investment banking and capital markets business at Lehman. That is a steal. And one of the things the reason it just jumps out at me is just yesterday we're talking about Verizon and its $49 billion debt deal. So who's one of the principal underwriters on that deal? It's Barclays. And go back to 2006, 2007, that would probably be Lehman Brothers there, not Barclays. Maybe Barclays would have been part of the deal, but not one of the lead underwriters. So this is kind of a big deal here. And I'll echo what you said, that compare it to what happened at Bank of America, where they jumped the gun and paid a ton of money for Merrill Lynch, when it probably would have gone the direction of Lehman Brothers. And who knows if there was behind the scenes pressure and that sort of thing. But in any case, Barclays got a steal here.
Absolutely.
Headline number 3, going over to CNBC's Net blog, and the headline is, "Yep, it's another housing bubble." This was actually an article from a blog post or article, whatever, from yesterday, but it was linked to a similar post from today, and I thought this one was a little bit more notable. Anyway, the opening of this article is 4 months ago. Something troubling happened in the housing market. The Home Price Affordability Index, tracked by the National Association of Realtors, slipped below its long-term trend line, making a possible beginning of a housing bubble. We've been talking about this with housing prices rising. David, it's here, the new housing bubble, right?
Okay, well, it's a trend line. Okay, so that's basically a historical average. So sometimes it's going to be above that, sometimes it's going to be below that. That's kind of how
it's below that in a bubble. We're in a bubble now, right?
That's how a trend line works. Okay, housing prices, Case-Shiller, up 12% year over year.
A bubblish 12%.
That's not sustainable. We all know that housing prices are not going to go up 12% a year. It just doesn't make sense with demographics. It's not going to happen. Does that mean everything's going to be so unaffordable that prices are going to start declining? In my opinion, no. Maybe it slows down a little bit. Maybe it ticks down a couple percentage points. Do I see a massive bubble here? No. What do you think?
The way this index works is that at a reading of 100, it basically means that people have incomes that let them qualify, just barely qualify for a mortgage on a median home and a median payment.
They're making just the right amount of money.
Right. So right before the crisis happened, affordability had fallen to the point where it was right at 100 there. And then since then, thanks to falling housing prices and falling interest rates, rock bottom interest rates, which make it more affordable, bring the payments down, skyrocketed to above 200. So basically people had double what they needed to qualify for a mortgage. And now they're back down to, according to this post, 158. So individuals are about 60% above what they need to qualify for a mortgage. So that's not worrisome. And overall, I hate posts like this because we're not in a housing bubble. It's very backward looking on what just happened. However, what I will say is that, is there a potential for us to have another housing bubble? And could this be an early sign of it? Yeah, okay, it could. I mean, if we're looking 5 years out, this could be inning 1 of the next housing bubble. But it
all depends on how you define bubble here too. Are you talking about falling 30% from the peak or falling a couple percentage points? That's likely, I think, in the foreseeable future that we probably will.
Well, to me, that's not a bubble.
Maybe I think in the short run you could see that potentially. We don't know. Anyone who thinks they can predict the housing market exactly what it's going to do for the next 5 years, they're kidding themselves.
If you look back at the Case-Shiller housing numbers, and it was actually funny because I looked at this before the crash. I remember specifically looking at this before the crash and thinking that there must be something wrong with the numbers that Shiller was using and calculating, because they just and for viewers that want to check this out, Robert Shiller actually maintains a website, irrationalexuberance.com, where you can look at all of his data. It's really, really great. But the prices just spike unbelievably, and that's what I would consider a bubble. Could that happen again? Yes, it's not out of the realm of possibility, but this is way too soon for anybody to be getting worried and really thinking bubble.
I agree.
We're pretty much done with earnings season now. There are a few late reports trickling out.
It's almost the end of the third quarter.
Right. We're looking ahead now. September 30th, we'll wrap up the third quarter, but we've got pretty much all of the quarterly SEC filings out, the full 10Q filings. So we've been digging into a few of those to try to find some things that investors may have missed and that may not have been highlighted in the quarterly reports. So today we took a look at Wells Fargo. What is it that you found in there that investors might not have otherwise been looking at?
So we just talked about the housing market. Obviously, Wells Fargo, very tied to the mortgage market, biggest mortgage originator in the country. So they make a lot of fees off this business. And if we think about just Wells Fargo's non-interest income, so not what they're collecting on loans and investments, so just the fee income, if we think about it that way. Deposit fees, brokerage fees and mortgage fees make up around 50% of that fee income. It's a fair amount. However, the other 50% is broken up between 17 different businesses there. So it just goes to show you that, okay, mortgage is probably going to slow down. They've come out and said that third quarter mortgage income is going to be lower. But it shows you how diversified their business is and how many businesses they have under their roof that they can continue to grow. Even if mortgage ticks down a little bit, they have 17 other businesses that make up 50% of that fee income. I thought that was pretty impressive.
Not to mention that the trust fees and the deposit fees, which are part of that first 50% grouping that you were talking about there, those are still going to those are going to be affected by the fall in refinancing.
Right. So mortgage, if it's lower, that's not great. But they have all these other businesses that they can keep investing in and keep growing.
So this is sort of a similar theme to what you're talking about here, and this isn't something that's specific to the second quarter. This is ongoing at Wells Fargo. But I was looking at the composition of the loan portfolio. Wells Fargo has $253 billion in 1 to 4 family first mortgages on its balance sheet, held on its balance sheet. Comparatively, it's got $189 billion in C&I loans, commercial and industrial loans, on its balance sheet. So when we talk about and think about Wells Fargo, a lot of it tends to revolve around consumer lending and in particular mortgage lending. They are the number one mortgage lender in the U.S. But to just think of Wells Fargo that way is to really undercut, like you were talking about, the diversity of its business. And overall, on its loan portfolio, 55% is consumer. A lot of that is consumer real estate. Most of it is that first mortgage. There's also some junior lien mortgage on there. There's some small credit card portfolio, comparatively speaking, an auto loan portfolio. But then 45% is commercial. So you've almost got, you're darn close to a 50-50 split between consumer and commercial. So this gets back to that idea that it's the change in the mortgage market isn't Wells Fargo's entire business.
Right.
And furthermore, looking at how this translates over to the income statement, $8.9 billion of Wells Fargo's $11 billion, or almost $12 billion in interest income during the second quarter came from loans held. So this is both the mortgage loans and the commercial loans held. So that's $8.9 billion. And what do they pay on deposits? They pay $353 million on deposits. $8.9 billion earned on interest income through the loans it holds versus $353 million paid out on deposits.
Not a bad deal.
That is why the deposit franchise at Wells Fargo is so valuable. And then you compare that to the mortgage banking fee income of $2.8 billion, and you see that's important, but that hardly tells the whole story at Wells Fargo.
And when you talk about the loans on their books, Tim Sloan at the Barclays conference this week was talking about the loans that they hold on their books between mortgage and commercial. Around 50% of the loans that they hold right now were originated after 2009. So they're not these old loans that were maybe a little shoddy.
Wait,
maybe
2007 loans weren't good loans?
Not the best sometimes. So after 2009, loans made during very tight underwriting standards. These are high quality loans, and
people with jobs and who can pay mortgages.
The way you should make loans. And mortgages originated after 2008 virtually have no losses. It's very impressive. The loss rate on those mortgages is essentially zero, not absolutely zero. Obviously, there's some that are defaulting, but the loans that they hold in their books, 50% are very high quality.
All right, moving on to our game for the day. We have a round of Rank It. We're looking at regional banks today. And the lineup that we have, Regions Financial, BB&T, KeyCorp, Huntington Bank Shares, and US Bancorp. The way the game works, it's simple. Rank them from 1 to 5 in terms of which one you like to own if you don't own it already. David, what do you have?
All right, we'll throw up my rankings here. 1 through 5. First one I got is Huntington Bank Share. Second one there is Regions Financial. So both of these banks here have consumer operations, but are also business lending. And the reason I have Huntington there is the management and their focus on the consumer business. So Regions a little bit more tied to the business banking and the business loan side of the business. Huntington is really focused on having a strong deposit franchise like a Wells Fargo. They're really focused on building that out. I like what they're doing there. The valuation looks attractive with both of these, so those are my top two. What about you?
So my top five are, it's going to look very familiar.
I've seen that before.
Huntington Regions, U.S. Bancorp, BB&T, and KeyCorp. I have obviously the exact same lineup that you do, which is a little.
We didn't plan that, by the way.
We did not plan that. So Huntington at my top spot. This is a really interesting one to me because every time I look at Huntington, this is one of those banks or companies that I think to myself, why do I not own this? Why have I not bought this for my personal portfolio yet? I think this is a really well-run bank. What I like is that Steven Steiner, the CEO, is really looking to differentiate the operations at Huntington. And strategically speaking, banking is a commodity business. So whatever a management team can do to differentiate a bank and to give it an edge over everybody else, that's huge. And I think Huntington is really doing that. They're looking to be very customer friendly with, I feel like a broken record saying this, but they have programs like their 24-hour grace program, which protects people from overdraft fees, and they have still offering free checking, which a lot of banks are moving away from. And they're looking to make banking as convenient as possible for customers, not only doing online banking and mobile banking like a lot of other folks are, but also opening up a lot of branches inside supermarkets, which are super convenient for people. Regions is my number two. I feel pretty good about Regions. I was almost going to put it a little bit lower, but I think there's a little bit of the love the one you're with on that because I do own Regions personally.
Not quite as cheap as it used to be.
Not as cheap as it used to be.
Running up a little bit.
Well, and that's good news to me because I bought it when it was a heck of a lot cheaper. I think that there's a lot of upside for Regions. It's in a bad region. It was in a tougher region during the crisis, and I think there's a lot more upside.
Right. I'll go into my next three there. We'll group them all here. The next one I had was U.S. Bancorp, BB&T, and KeyCorp. So U.S. Bancorp, BB&T, these are high-quality banks. And that's kind of made its way into the share prices here. These are pretty rich on a valuation perspective. They usually back it up with performance, but when I just look at what they have to do to achieve better returns than a Huntington and a Regions over the next 5-10 years, it's a little bit of a higher hurdle. I don't think they're bad banks to buy now. I just don't think you see as attractive returns. They're obviously very attractive fee businesses at a U.S. Bancorp. BB&T, a good mortgage business. They recently bought Crump Insurance and moving into the insurance business. So I think they're good banks. I just think the valuation's a little rich. And the last one I have on there is KeyCorp. Little uneasy with the KeyCorp strategy, focusing on middle market businesses. They do have the consumer business. It's not as strong as these other banks we mentioned. Don Kimball, the CFO, he was over at Huntington, went over to KeyCorp, very close in geographical area as well. And at the Barclays conference this week, they asked him, what did Huntington have that KeyCorp is kind of lacking right now? And he danced around the question a little bit. Obviously doesn't want to talk about his former employer that much, but he really stressed how much of a strong franchise Huntington had with the retail business there. KeyCorp's not quite there yet, so for now, they're my number five.
Okay, I'll just agree with you on your thoughts on BB&T and KeyCorp. That'll make you happy. It makes me sad to have to agree with you. U.S. Bancorp, pretty much on the same page. I think U.S. Bancorp is simply one of the best run banks in the U.S. Like you mentioned, it's an expensive stock. It is, but they have a very strong fee business in particular, which serves them through up and down markets, which I think is really great and has helped them. I mean, if you look at a return on equity of 16% right now in this low interest rate environment, that shows the strength of U.S. Bancorp, particularly its fee-based business. It's a little bit, and actually if you look at also the non-performing loan ratio at U.S. Bancorp, it's 0.7%, which is the lowest among this entire group, and that speaks to the quality of its loan underwriting, which is also important for long-term returns. So it's a little bit expensive to buy right now, but I don't think it's a bad buy, and I think it's the kind of bank that you buy and you hold and you hope that something stupid happens in the market.
Yep.
The market is irrational all the time, and you get a chance to buy more at a better price.
Yeah, I mean, they have a CEO, Richard Davis, that I don't know if you can say this about a ton of banking CEOs. I feel like you can trust Richard Davis that he has the business in the right direction. And like you said, if there's an event that drags the valuation's down, the price is down. I think that's a great bank to buy.
All right, wrapping up as we always do on the Twitter sphere. David, what is our first tweet?
The first tweet, we've kind of got a twofer here. So the first tweet was, what a boring Bank of America presentation. And then the reply from Crowd Turtle was, went through the Bank of America presentation this morning, nice and boring, and trends improving, just like I like it. Matt, do you like boring?
I do like boring. I like boring when it comes to banking in particular.
Come on, CDO squared.
I have been saying for years that banks need to be more boring, and in particular, Bank of America needs to be a lot more boring. Bank of America has been way too exciting over the past few years. The time is stretching out now. Over the past 5 years, 6 years. Going forward, a lot of the story in terms of showing the earnings power that Bank of America has is taking costs out of the system. That's really boring, but it's going to get shareholders what they want.
Yep.
Number 2 tweet we've got coming from
the CFPB.
The CFP.
Or about the CFPB.
This is about the CFPB. The tweet is 6-figure salaries go to 741 employees, or 61% of the CFPB workforce, with 1 in 4 taking home $150,000 or more. That's from Financial Services. David,
they're just across the river, right? I gotta go get a job at the CFPB.
Is this worrisome to you that that CFPB employees are getting paid so much?
First reaction is, wow, that's a lot for a government job, but quasi-government funded through the Federal Reserve. I believe we have that right. So quasi-government there, a lot of money, but you do want people that are qualified dealing with this, so it's hard to gripe with it too much. I mean, it's not like they're making millions of dollars and getting taxpayer bailouts, as some people might argue. But yeah, I don't know. What do you think?
I don't have any problem with it at all. Look, the thing is that on the regulation side, we need people there that are of the caliber and of the same caliber that they're trying to regulate. And the problem is that over on Wall Street, there's so much money being made over there through investment banking, through trading, that they can pay hundreds of thousands of dollars, millions of dollars to investment bankers and traders. And the problem is that why are you going to go over to the government side, to the regulation side, and make $60,000 when you can make $500,000 over on the private side? These kind of salaries don't make it fully competitive. But at least they give a very good or a good lifestyle, or a very good lifestyle, I should say. Those are very good lifestyle type.
It is
of
Washington cost of living. It's a little high.
Fair enough. But you got to be competitive. You got to be competitive to get good regulators in there. So I don't have a problem with this.
All right. Moving on to our last tweet. It's about your boy, Vladimir Putin.
Yeah, my boy.
From Jack Schaefer. So when does President Obama retaliate against Putin with his Times op-ed? What do you think? Should he go to the Times route, or should he? We don't like to be political. Maybe he should give his op-ed on Fool.com. That could be good for us.
I think he should give his. I think that's exactly what he
maybe
should.
on where the money is. He can just do it live. We've got teleprompter.
Yeah, we'll do it live. We'll do it live.
Fine.
We've got an extra spot here. I'll scoot over. You'll scoot over.
That'll work.
The president will sit right here. It'll be great. Or the other option is to have him on BuzzFeed to do the retaliation on BuzzFeed.
Through like 15 animations.
10 amazing reasons why Vladimir Putin's op-ed was ridiculous and terrible.
The sad thing is that would probably get much more views than a New York Times article. Maybe not sad.
It would be much more exciting.
More
exciting. You could do animated GIFs of President Obama and Vladimir Putin. It would be amazing.
We need to get the White House on the phone.
All right. Thanks for watching, folks. Again, I'm Matt Copenheffer, and this is David Vlad Hansen. Thanks again for watching, and we'll see you tomorrow.